It's a hard argument to make that that clients should rush to put new money to work right now. Being at all-time highs sort of has this connotation that we've already the move has already been made and it's too late. We've missed it. But statistics actually suggest that at all-time highs, what's more likely to come next is another all-time high. There's reasons why markets that are at all-time highs rarely crash. And one of them is that a strong market generally makes it inexpensive for large institutions to hedge their positions. So people are already positioned for prospective downside to occur. And so the market mechanics makes it more difficult for a market to make a large down move, at least all at once. And also, when you're at all-time highs, that sort of implies that the market has been strong for a period of time. It doesn't, we're not in a huge drawdown and then all of a sudden we're at all-time highs overnight. It's something that happens over time. So people are nervous though, and people aren't really less nervous than they were just a couple of months ago. Headlines are still fairly volatile. There's the threat to trade partners about additional tariffs. There's just uncertainty around trade policy still. And I think markets being at all-time highs is a little bit unusual to have the sentiment be as nervous as it is. So I think what we're telling clients is we're being honest. There's no reason to rush to put money to work simply because you have cash on the sidelines. A diversified portfolio is always going to work. It's going to protect you against downside, and at this point, there's opportunities in fixed income. You can earn 4.5–5% on short-term fixed income. It's a great place to hide if you are nervous. It's also a great place to hide, for a period of time if you're just convinced that there's going to be a pullback soon. So everybody's different, but it's definitely a unique time. It's just such a perfect encapsulation of how unique and strange this environment is. That, and just to summarize what you said, the market, last time we did a video, market was a little bit lower and the fear and greed index was higher. We were in an extreme greed phase, which just means that positioning and expectations for future volatility are measured in a way that people are expecting further upside. And now that measure has come down where we're sort of neutral. The market is no longer pricing in extreme greed, and it's not fear either. It's sort of in the middle, but the market is actually a little bit higher than it was a month ago. But the market is higher because there's other stocks and areas that are picking up the slack. We're seeing sort of recoveries in areas like healthcare and energy. Biotech has actually been pretty solid lately. So breadth, which is really just a measure of how many things are participating in whether the market's going up or down. Breadth is improving. So we're getting some hiccups from the former leaders, but some of that is getting helped by former laggards. And I think, just sort of generally speaking, that's the mark of a healthier market. So data in all sorts of areas, growth and market breadth is more favorable than it was a month or two ago. And I think also sentiment being worse is better for the market. So it's pretty interesting. It does feel like there's a tug of war happening, whether it's between Powell and Trump or between the inflation and growth data, the need to potentially hike rates or cut rates. There's a lot of combative dialogue that's happening out there, and I don't know that I can speak intelligently about what's likely to happen. I think that you're right that the data is sort of suggesting that inflation is not cooling. It's picking up slowly, and it's going to be very difficult. And we're going to show that diagram that Goldman put together, where costs are being absorbed. The higher costs due to the tariffs are being absorbed currently by U.S. companies, but that's likely to shift over the next couple of months. So I think it's about 2/3 of costs from the tariffs are being absorbed by companies, and that almost that exact same number is going to get passed. It's going to shift to about 2/3 gets passed along to consumers. So we consumers aren't really experiencing the bulk of price increases due to tariffs yet. And we're expected to, at least if you believe Goldman, over the next 2 to 3 months. And so, yeah, that's going to hit inflation readings. And if Powell cuts next month in September, before that data truly flows through, he may end up having to revisit, because if inflation then starts to tick up again, he'll either have to stop cutting. It seems unlikely that the Fed would, there's just been so deliberate, unlikely that they would cut and then wait and then hike again. That would send a really messy message to the market. So it's possible that they don't do anything again, and they just say we've got to wait. We understand that there's more data that we need to see. That would infuriate Trump, and who knows. But yeah, the next couple months are going to be important to see if there's a new trend on inflation, because it has been trending lower for the last couple of years, and we just didn't quite get to that Fed target. If it starts to tick back up, I think that's going to be problematic maybe for both stocks and bonds. So in the event where inflation does start to pick up in a couple of months, because the phenomenon that Goldman is implying could happens, then what you could see is weakness in some of the readings on consumers, weakness in the stock market, rates going up, which means bonds losing value, and ultimately a weaker consumer and potentially a rise in unemployment. And then all of a sudden, the Fed's in a position where they have to cut. So, tug of war. It is a challenging period to answer the question, what could go right? Because there is a lot that is already going right. And in my opinion, it's going right in spite of a lot of negative themed headlines and news and uncertainty. So I think the biggest issue at the moment is Fed expectations and whether or not Powell is going to cut, and what's going to be the reasoning for the cut. So we all know that Trump has been pushing him to cut and sort of berating him for not having done it sooner, to provide a little additional stimulus to the economy, which the economy is sort of telling us it doesn't need. But if Powell is able to sort of thread this needle and initiate a slow and steady rate cut cycle for the short end of the curve, and to do so without appearing that he's placating Trump, that there's good justification for doing this. Inflation has in fact moderated. We've maybe got a one-time hit from some tariffs and inventory building by companies trying to get ahead of tariffs. If he's able to deliver a rate cut and a speech that convinces us that this is the right timing, and also the long end doesn't react negatively, meaning long rates go up, that would be harmful, harmful for mortgages for obvious reasons. So I think we're in a position where what could go right is a needle threading by Powell, and just data continues to come in as it has, which is not spectacular, but it's positive and it's trending in the right direction. I think that between now and the end of the year, that would be terrific. We answered this question 6 months ago, what could go right? And it was, we're coming off 2 great years in the market. A positive, but mildly positive, like mid-single digit year would be great. We're already above that. So, let's be thankful for what we've gotten and just see what comes next.